Welcome back. In a speech to the Senate Banking Committee earlier this week, Federal Reserve Chairman Jerome Powell warned that causes of the recent rise in inflation may last quite a bit longer. Powell said economic growth has continued to strengthen but has been met by upward price pressures caused by all kinds of stuff, supply chain issues and other factors. He also warned that the Fed is going to start pulling back on some of its stimulus that it provided during the pandemic. Well, his comments sent the markets into a bit of a tizzy. Joining us this morning to talk about that is our financial expert, Bruce Allen of Bruce G. Allen Investments. Bruce, good morning.
Good morning, Gary.
So Jerome Powell spoke. His comments have impacted the markets. They've been all over the place. What's going on?
I think the big thing that markets took away from his speech last week as well as this week was that the Federal Reserve will taper off or slow down the amount of bonds they're buying. The Federal Reserve has been buying U.S. government bonds and mortgage-backed bonds to help push down longer-term interest rates. And they're going to gradually stop that probably by the middle of next year, Gary.
All right, so interest rates, I mean, he talked about that too. How has that been impacting things?
When the Federal Reserve started buying bonds, they became one of the largest buyers of long-term government bonds and mortgage-backed bonds. With them stepping away from purchasing bonds in the marketplace, interest rates are rising in anticipation of that. And we saw the yield on the 10-year Treasury bond, which is the long-term bond benchmark, rise from 1.3% last week to 1.54% today, Gary. That's a pretty fast jump, almost a full quarter of a percentage point in a matter of weeks. And we'll see that the long-term Treasury bonds may be rising further as we go through the rest of this year and into 2022.
So what do you think the future is since they're pulling back from their bonds and other purchases? What do you think the future looks like as far as the Fed and how it's going to affect the markets and therefore you and me, I guess?
Jerome Powell's been very clear about this. The first step is to stop the bond buying, and they plan to do that by the middle of next year, Gary. And then it's likely that while interest rates may rise on the long end, they continue to maintain short-term interest rates at these very, very low levels. Those short-term interest rates will likely start to rise at the end of 2022, beginning of 2023, depending on how the economy continues to grow. And the Fed has been very lax about, or very hands-off about, dealing with the consistent and very troubling inflation rates that we've seen over the last several months. Their argument is it's very temporary, but we'll see. And I think that it's interesting to see how this unfolds. If anything, markets are concerned about rates rising, and the bond market and stock market are taking that new data into account. And that's caused some significant volatility in the stock market over the last week and a half.
And I expect we're going to see even more of that coming up. All right, Bruce, thank you very much. As always, it's good to see you.
You as well.
Okay, take care.
You too.